Okay, so as you know, I was headed. I went out of town this last weekend. Went down south, caught a 49er game,
Right.
and on the way, we were driving to Tesla, which had which had Apple Music, Spotify, and TuneIn, which is a radio app integrated. You've had a Tesla. You don't own one now, but you've owned a Tesla, so
Right.
you're familiar with the integrations. So what do you use to stream your music?
Well, I use Apple CarPlay, so that's one thing that's not in the Tesla, right? They have that in lots of other
But even not in the
manufacturers.
car, like you're doing yard work or you're running on the treadmill, you're streaming your favorite workout mix. What are you using?
Probably Amazon Prime because it's free.
Really?
It's not great. I would imagine Spotify is like way better. I think that Amazon Prime is a little redundant in terms of the music that they play, but at the end of the day, I'm thinking it's free. So I'm gonna use. So that's what I use in my car. Like I have Apple Play. I turn on the Amazon, Prime Music app.
Yeah,
that's what we use to listen.
Yeah, I was gonna say because
I'll be honest with you.
What's on your phone, but if you were to play music on CarPlay, you're using Amazon Prime Music, huh?
Yeah. I like to fast forward through songs, right? I can't deal with the radio anymore and hearing a song that I don't want to listen to. So that's why. But music is for when the kids are in the car. When the kids aren't in the car, then it's usually I'm listening to a podcast.
Yeah, I listen to podcasts also. And
if I was out in the yard, to be honest with you, it's probably going to be a podcast.
Yeah, I'm listening to a podcast doing yard work. Frankly, when I'm working out, I'm listening to podcasts. It's pretty much, this is Gen X version of talk radio, right?
Yes.
Might as well. It's kind of AM radio. But that's fine. I still, there's still got to be music sometimes playing in the background, like in the car with the whole family where you're just playing kind of road trip music. I actually subscribe to both Spotify and Apple Music.
Okay.
And Spotify wins for best like curated playlists. So if you want a 4th of July barbecue playlist, Spotify's got you covered. It's better than Apple's. But Apple, I think, works better for all of my devices because it's Apple TV. It's on the laptop, it's on the thing. So
you just turn it on and play it on no matter where you are.
Yeah, but the reason we have two is because my wife likes Spotify better. So there you go. I might be converted if I go electric. Spotify's in whatever I'll be using, and Apple Music may not necessarily be. So we'll see. But it's all bundled, so that's how you wind up with two also. All right, enough about streaming music apps. Let's jump in to some charts and some market stuff. You ready?
All right.
Let's go. So I think we'll start maybe by introducing ourselves. This is something we're not very good at introductions here. Ryan, you're Ryan Louie, CFP financial advisor here at Ford Financial Group. I'm a CFP. My name is Brian Ullman. I'm a CFP financial advisor at Ford Financial Group. I'll start by saying if you're new to the podcast or the video, what do you call a video podcast?
Yeah,
we'll go with that.
Most people are going to watch on YouTube, but I guess it's a pod.
We do get more views on YouTube, I will say, but well, not necessarily more. It's interesting. When someone subscribes to the podcast, whether you can find it on Spotify, Apple, Google Podcasts, you said you use Overcast, for example, whatever you listen to it on, we're on there. When someone subscribes, it downloads everything in bulk. So it's hard to do a one-on-one comparison, but I'm surprised that we've gotten some more viewership, particularly on some of the private stuff we send to our clients. Lots of views. So whether you're liking it on YouTube or I guess subscribing on YouTube, or if you're listening to this on the treadmill or doing yard work like Ryan and I do, you can subscribe and listen to us every other week is when we put these episodes to work. So with that out of the way, let's start market recap. Ryan, have you been watching a little bit of what's going on with markets here in these last 2 weeks?
Seems like it's like, it's the typical conversation you get with clients when you talk to them about the markets and they're saying, oh yeah, I know. Just seems like the market goes up one day and goes down the next.
Well,
it seems the little bit maybe more down than up.
Yeah.
But
Well, here, let's take a look. This is going to be kind of dark. This starts with a Dow, but I could probably change the settings here to make it a little bit lighter. But you can see here, essentially, here, let's do the last 10 days. You can see here the break-even point. We're negative the last 10 days. And so this isn't exactly 2 weeks from when we last recorded one of these, but suffice to say, even if we took the Russell out of here and just focused on the three major indices, all three are down. NASDAQ down 2% over the last 10 days. S&P a little bit more than 1%, and the Dow down 1/3%. So not great. But 1/3% isn't a whole lot. I think really what we're looking at here is the fact that everybody's kind of waiting around, seeing what's going on with the Federal Reserve, which is going to come out with its statement here before we're recording this on Tuesday, and they'll announce here before this actually drops on Friday. So we'll have some news making going on in the interim, but this feels like everybody's kind of hanging around waiting, doesn't it?
yeah, don't think that there's too much expectation. I mean, they could always surprise. I don't think that that's the likelihood that they're going to see a rate increase this time around. So with that in mind, it's almost like if they meet expectations, we move on, and then we wait to see what happens at the next meeting.
Yeah, I haven't looked at the latest kind of handicapping going on with the likelihood of rate increases. It's definitely below.
I think it's almost like I think they were saying almost like a 1% chance at this point.
Oh, it's down that low now.
Yeah, it's like really low that it's going to actually happen this meeting. But we all sit and continue to wait, right, and just wait till we get news that the Fed's going to stop hiking, and then subsequently we all want them to start maybe reducing rates. Some people probably don't. If you're a savings type of person, have money in the bank, you want that high interest. But as far as investors are concerned, I think investors that have money in bonds and stocks would definitely want the interest rates to go down.
Well, I think the Fed needs more data. It's not surprising. The last kind of two meetings, they paused in June, rose in July. Wouldn't surprise me if they paused here in September and rose in November if they felt like they needed to. The inflation reading that just came in, or some of this inflation data that just came in, was a little bit hotter than I think some people expected. If that continues, then you could expect a rate increase in November. If that's an anomaly and this is kind of a bump up before we continue our trot down in inflation, whether it's housing or whatever, the Federal Reserve raising rates isn't going to like cool off oil prices, right? It's core CPI, and that's probably what they're focused on. It wouldn't.
Well, we've said even since the beginning when they were starting to raise interest rates, and we knew inflation was eventually going to come down, that they said that it wasn't going to be a straight line down, right? And I think we kind of have seen this where you can have a month that the inflation seems to bump up. I think that the Fed probably is okay with that, in the sense of knowing that, again, it wasn't going to be a straight line down. And then if that's okay, then we probably, maybe we get one more interest rate hike, and then that's it. We just can't see multiple months. Like if inflation kicks up 1 month, but then 1 month becomes 2 and 2 becomes 3.
Yep.
We're gonna have some issues with what the Fed's gonna want to do.
Yeah, and I really think it's less of whether they're going to raise rates 0.25% September or November and then stop. I mean, we've said this before for several months now. We're probably pretty close to being done with the rate increases. I think what we need to settle in for are these higher rates than we've become accustomed to for a much longer time. The Fed is not going to lower rates until they see there is a recession that is here without a doubt, because they're not going to use all their ammunition. They're not going to lower rates just because inflation stopped going up. They're going to lower rates because something's gone wrong, and they need to handle it by lowering rates. They reduced the money supply also. That's on the other side. There's a lot of tightening going on. I promise I'm not going to be doom and gloom like I have been the last couple of these episodes.
The one interesting thing that's going to be coming up very shortly in a couple months is holiday spending. So it'll be interesting to see if all this tightening has effect on the economy to where
Yeah.
spending for the holidays is a lot lighter, because that's always a big like indicator of how well the economy is doing, is how much people are spending.
Yep. And spending has maintained. It's on the back of increasing credit card and debt balances, and on the back of I won't go into the low U.S. Personal savings rate is slumping. Like, there's no doubt about it. You got oil prices going up, and you have lending standards starting to get real tight. I mean, dude, these are the ingredients. I know I sound like a broken record, but they really are the ingredients. They're not the ingredients of a soft landing. I'll put it that way.
This is what the Fed wanted to an extent when they started this too.
Absolutely. One could argue they need a recession to actually snuff inflation, but that's not what we're talking about today. We'll save that for another episode. Let's dig into your chart first, because you found this on top-down charts, which I think is the guy produces stuff on Substack, this is an interesting take. Explain what's going on here for people.
Yeah, so this is actually just a comparison of U.S. technology companies. If you think about comparing U.S. technology companies to international technology companies, when you see the line go up, it means that the U.S. technology companies on a stock price basis are doing well versus the international technology companies. And when the line's going down, that means the international technology companies as a whole, their stock prices are doing better than the U.S. You can see here, it's been quite a run for the last 15 years.
Yeah, you can say that
for the U.S. stock companies versus the international. Because one of the discussions we often have, like in the investment world, is just in a comparison of how is the U.S. doing versus international stocks,
right?
And we, those of us in the industry know that the U.S. domestic stocks have done so much better for a long period of time versus international, whether it's developed or emerging markets, for a while now. But sometimes when you compare the indices, the problem is that the sectors are not equal, meaning that the problem with the U.S. sectors is that technology plays such a much more a bigger role. They have a bigger allocation in the indice versus the international one. So when you want to compare just like technology to technology, you get the idea that the prices in the U.S. stocks have played such an important role, and have been such a major factor, I think, versus the international technology companies as a whole.
Well, and the way this chart looks also is, it goes basically exponential almost from 08 up, to just straight up. But really, from 88 till now, you could kind of, if you're a technician, you could kind of show that this is the direction that it's been headed, with the exception of those late 90s kind of overvaluation, and then the tech bubble burst that came in the early 2000s. Like, that's reflected in here, but really there's a tech bubble, a burst, and a recovery, but it's been basically chugging along much better since 1988.
I don't think this surprises anyone, right? We know that what has made us dominant as like a U.S. economy over the last, definitely, I mean, for a while now, but definitively the sector that has really helped us over the last couple of decades is technology. We're talking Google, Amazon, Microsoft, Apple, right? It's those,
even just generally, like in our history, it's been innovation, right? We are structured in the way of our laws, and just kind of the way this I don't want to say capitalism, but the structure, the U.S. structure favors innovation and protects
entrepreneurship. Creating new things. If something else is old and kind of broken, there's a chance for somebody else to come and take that company's spot.
Yeah.
And technology is such an important part of our lives and everyone's lives across the world. And these are the companies that are being used. A lot of them are U.S. companies, and so therefore it gets pushed into the stock price of these U.S. technology companies. And you can see it in this chart that it's the U.S. technology companies that are dominating kind of the world at this point. Yep. I guess the one downside to this is that when things get overextended, you always wonder if things are going to come back the other direction, right?
Revert to the mean.
Revert to the mean, because I think if we put this on if we were to do some graphing on this, we are a couple of standard deviations out of the norm. So
Yeah.
it's like the rubber band effect, right? You pull the rubber band too far one way, it should snap back to the other direction.
Yeah, but I would say that's more for like pricing. This is like it's just because one country has innovated more than others doesn't mean that is now the turn of the other countries to innovate more, right?
I think that's where like the rational side of this would say, why would this chart start to go down? Because like what companies internationally are going to take the place of the US? And if they're not, you would assume that the US technology companies are going to continue to dominate. The prices will continue to go up.
Yeah.
And the chart will continue to go up. I mean,
you don't want to have too much hubris and just say, oh, well, we've won. And we being the US has won. And therefore the relative performance is always going to be huge. That's not necessarily the case. But, especially maybe more now than ever, because you're producing software, not products as much, you're able to build on top of things. And so when you've got a lead, you're able to extend that lead right now. And certainly that's something that Google is facing with their antitrust stuff that they're faced with now. And others have dealt with the same. And that's why Apple is putting a USB-C port on their iPhone. But with short of those bumps in the road, you're building on top of systems and integrations that you already have. And so the rich get richer, so to speak, from a tech perspective, unless something really is innovative and different. Spotify is not US, for example.
right.
We were talking about the streaming companies, but are they so far ahead? They certainly integrate with more things, but are they so far ahead? I would argue that kind of streaming is commoditized at this point, seeing as you're using Amazon. You might be the only one.
I would say the one company technology wise that wasn't really probably thought of just even a few years ago, which is super relevant today, is NVIDIA, right?
Sure.
We say Microsoft, we say Apple, we say Amazon. We're used to hearing those names for decades now, right?
Yep.
But here comes a new player in the technology sector, and it becomes another American firm. NVIDIA is now really important to the technology sector, and making chips that are going to be relevant for what we need going forward.
I think this is where I will jump in and say past performance is no guarantee of future results. These are not recommendations. Yada. Please see all the disclosures at the end of this video or at the end of this podcast or in the notes below if you haven't clicked through any of those.
Yeah, we are definitively not saying in technology, U.S. technology is only going to go up, because it has its rough spots for sure.
Yeah, I mean, look at COVID. Like, boom, it cratered. And honestly, this category is going to be hurt the most by higher rates for a longer time. Also,
yes.
So that's really where you get into past performances and a guarantee of future results. But technology touches all of our lives, and if you want to use the Warren Buffett approach of like investing in what you use a lot of, chances are you use a lot of technology, whether you're streaming the football game on Thursday night on Amazon, or you're listening to Spotify in your new electric car, or whatever it is. It's more part of our lives than ever. That's for sure. Okay. We'll move on. We'll link to the top down charts post, so you can grab this chart if you want to see it for yourself. My charts have to do with government shutdown. I don't know if you've been watching the news, Ryan, but we are on the verge of we're 12 days away now, as of today, from a government shutdown, unless a temporary extension is agreed to. It's been floated out there, but it's unlikely. So suffice to say that probably before we do our next podcast, we will have the federal government shut itself down, for better or worse.
Yeah, but it's one of those things that it hits the media. The financial media will use this just because it's a talking point of something that kind of ruffles the feathers and gets people to pay attention.
It allows the Congress people whose oxygen is media and mayhem, more media and mayhem to focus on. And you're right for your skepticism. We talked before about the debt ceiling stuff. That's definitely playing with fire more than a federal government shutdown is.
Right.
because now we're dealing with the full faith on the debt ceiling stuff. We're dealing with the full faith and credit of the United States. We're choosing not to pay our obligations. This is not that. And so you're right to be kind of disinterested in this, I would say, because we've actually had 20 shutdowns since 1976. This chart's from LPL research, and I'll post the link in the notes here as well. We've had 20 shutdowns since 1976. The average length is 8 days, as you can see on this slide. And the last one, I don't know if you remember the last one, but it was the longest in history. My neighbor actually worked for Department of Homeland Security. He was busting drug dealers and stuff. The guy was, the kinds of stuff he did was nuts. I can't believe he did it, but he's a nice guy, and he didn't get paid for a month for putting himself in harm's way, which was awful.
So it's funny. One of our speakers is back in the day was my friend Jeremy, who was he's the FBI agent, and when he was going through this, I think their whole office. I hadn't seen him in a while, but I saw we had Chipotle. Like during the government shutdown, and he had grown a beard, and it was basically he was growing the beard as long as he wasn't getting paid, and so he definitely had a full face of hair on him, because it was over a month.
It was, and it sucked, and the screws get tighter and tighter as it goes on, and finally the politicians have to stop politicking and start governing at some point. But this is when national parks get shut down or federal employees don't get paid. It's lousy, frankly, and it's bad stewardship of our country. But as investors, we're lucky enough that we can be myopic and say, how does it affect the investments? And the answer is it doesn't really. It's hard to say, oh, here's how markets react, because markets had a rough time in the 70s, more often than not a good time in the 80s, 90s, and after that. But really, historically, markets kind of don't care. And you can look at these returns and really peg what's going on during these shutdowns, because A, they're brief, and B, there's other stuff swirling. Right now, it's what's swirling is what's going on with the Federal Reserve, what's going on with the interest rates, are we facing a recession, or this kind of stuff. If you look at the simple average during the 20 government shutdowns that we've had since 1976, the return on the S&P 500 is positive 0.04%.
So basically nothing. Let's just call it. It's flat.
And frankly, you look at the return from 2019, that's a longer period of time, right? Because it was the longest stretch, and it was up. 2019, we were coming off a lousy 2018 where interest rates was rising, and interest rates were being cut in 2019, and so markets were moving on. So again, like, I don't think I'm having a hard time finding correlation. And a lot of people want to say, they ask, what's going on with the election? How does that affect markets? What's going on with the government shutdown? How the only ones making or losing money on this are the advertising executives for cable news networks. Honest to God. Because the most recent shutdown returned better than 10% during the shutdown.
Yeah, those are those situations where I think if you ask people prior to the event actually happening, if you laid out this, said, hey, the government's going to shut down for over 30 days, and you have the option of choosing to be in the market or not be in the market, knowing that this is going to happen. Most people would have said, I'm out. Like, get me out of the market if this is going to happen. And look what you would have missed out on.
Well, last time for sure. But yes. I think more importantly, what was going on last time was interest rates were being cut. And right now, interest rates aren't. I think what's more interesting, and I don't have the chart for this, but history also shows that there's a little bit of a bounce after the resolution of this. So if anything, markets are less affected by the shutdown, but there could be a little bit of a relief rally afterwards, not unlike when we had the debt ceiling raised, where you get this like, oh, okay, well, at least we've got that issue off of our plates and something that we don't need to worry about. So my estimation, low correlation as far as market performance is concerned with government shutdowns. And if anything, there is no correlation, and history shows a bounce afterwards. So there's no
Yeah,
need
I'd
to try and
say
time this thing.
people will probably see a lot of, if this lingers around for a little while, you'll see a lot of headlines, but probably know that it's not going to have much effect on the portfolio, or at least historically, it's been a non-factor overall.
No, it's not investable information is our take. And you know what? Sometimes knowing that something's not investable information or actionable information is a good thing. You got to know what to focus on, what not to focus on. And I don't think this government shutdown for investors is something to focus on. I say to everybody, what worries us as citizens is different than what worries us as investors. So as citizens, yes, we would like our government to be able to function normally and fund itself and not back itself into corners. Sadly, that's not the case. But from an investment perspective, nope, there's nothing cooking here, I don't think. Okay, that's the last chart that I have. So now it's our favorite segment here. What's on your mind, Ryan? What is on your mind right now?
Okay, so I'm going to kind of continue with something I mentioned before, which is podcasts. And I said that I listen to like a lot of health podcasts, and
oh yeah,
it's one of those things where you get there's a lot of information. I will say that there's probably very little that I actually do with the information, because there's so much coming at you that there's only so many changes you can make with like your health and your diet and exercise, all this stuff that they're spitting out, right? But the one thing I kind of spent some time recently doing, and I'm going down the rabbit hole here, is trying to find like a blood test that has all the markers and like have a baseline, because I think like that's probably a good place to start. Is you need to know where your starting point is. So I was looking, I've looked at some different ones. They have them on the internet, and some of them have some nice bells and whistles. I also just kind of wonder, which I don't know, I need to talk to my doctor about, is, what kind of blood tests can they give you? Like, and can you ask for a much more expansive one than they're willing to give you originally? A lot of times, the types of blood tests I normally get have to deal with maybe some kind of issue that I'm currently having. So they'll run a blood panel to kind of narrow it in on there. But I'm looking for something more broad.
Well, you want to be proactive, not reactive.
Correct. Right. And most doctors like,
so you can address it rather than trying to triage some problem that you're faced with, which makes, for you and me, makes sense as patients saying, hey, let's prevent problems. Sadly, that's not where the money is in modern medicine, but
yes. So I've been researching and trying to find, a way to do this, and what makes the most sense.
So you've got an appointment with Dr. Peter Attia.
Yeah. Yeah. Right.
Do you really?
Huh?
I was gonna say, I thought you really did. I was gonna.
No. He's I think he's like $100,000 a patient is what he charges.
Good gravy, really? Yeah. Oh my gosh! Good thing he made enough money from the books. Okay, so where'd you land?
So again, Huberman has one, not himself, but like he has a place that he recommends.
Yeah,
I may look into it. Like I said, it has a more exhaustive. I think it's like 42, 45 different markers that it's going to look at.
Place.
What
location?
No, everything. That's the thing. You go down and get your blood taken. They send it in. You get the results. It's on your phone.
So you're just gonna like go to Quest and get your blood taken? You don't have to go to a special lab?
No, you don't have to go to a special. Yeah, you just go to Quest. They get the results. So the company you pay for gets the results. They're matching it up to say, where are you? Where do you fall? It's all like pretty elaborately done through on your phone in terms of the markers and where you stand. It sounds interesting. Like I said, I feel like there's some takeaways that I probably can find out about stuff that I don't know about myself, health wise. I think it's a good starting point. And, you got to have a baseline. This might be it for me.
This could be your baseline. Or do you share it with your primary?
I don't know. I mean, maybe if there's some problems, definitely if there's some markers that I say are problems, I would. I don't know that I would just go in with.
You're going to go to your primary and be like, hey,
look, I have all these results. I'm playing my own doctor on the internet here. Let's get active here. I don't think I want to do that, but if there's some real issues, I might ask for some suggestions.
All right. Well, that's cool.
What's going on with you?
Well, I think where we left, I kind of on a continuation last week. I went down south, and one of the things I did was test drive some electric vehicles. They're not cars necessarily. Drove the Tesla, drove a Rivian. I'm conflicted. I think I was telling you this a little bit earlier. You know, it's the Rivian is a nice car. The pricing for me is different because I got on board like years ago on this list, and so they're honoring like really original pricing, so it's not that expensive relative to some other options kind of in the same class of cars. But it's a $7,000 truck and it handles that way, and I don't know that I want a big heavy car. And I was impressed by the Tesla. Not to say that I won't get the Rivian. In fact, I probably will just stick with the original plan and getting the Rivian. But it was an interesting.
At least
I took
comparison
the EV Pepsi challenge this weekend. We'll put it that way.
Well, even for that matter, you had the Polestar before, the week before. So
yeah, that's right. So I've got 3 under my belt now. The Polestar is a no-go. The interface is kind of just a dressed up regular kind of car interface. It's just I think it's pretty affordable for someone who's maybe young, who doesn't need a big car, who is staying in town.
But really, at that point, so is the Model 3, right?
I was gonna say, I don't know why I would buy that over the Model 3. I really don't. One of the things I was most impressed with was the Tesla autopilot assisted cruise control stuff. It was amazing. It was amazing. And I didn't get to test that on the Rivian, so I don't know how that would work. But it's I will say it's pretty clear to see why EV is the future of cars. And there will always be a place for gas cars, I think, just like there's people who still ride horses. But it's not going to be people's everyday, just because the cars are so much better. The performance is better, the bells and whistles are better, the technology is better. I can see why. I have a little bit better understanding of why these unions are fighting right now with the major automakers. These major automakers are in a bind. I don't have sympathy necessarily, because I think they should have been innovating a long time ago. But they're faced with having to kind of turn the battleship and fight with their own employees at the same time while they do it.
Yeah. To add to that, I had heard someone say that, one of the big problems is that for every EV that they sell, that means that's one less gas car that they're selling, right? Like, if you kind of the old manufacturers,
right? And
the problem is that unlike Tesla, they don't make money, or not nearly as much money, off of an EV that they do off of a gas car. So it's just a lot of things just are backwards for them.
Well, I also think about it, Ryan. The dealership thing alone. Yeah. Like going and sitting for an entire day and haggling over the price of a car with a salesperson. I know the internet has taken some of that away, but versus just click on your phone, you can. The buying process for these EVs are so much better.
Well, I think everyone's okay with just buying the price that they see on the internet, right? Like, not having to feel like you got to go and negotiate it.
You got to go negotiate
the same price.
And then when you're done, like on my car, I've paid for 5 oil changes over the next couple of years, and I've got to go down every 6 months and get my oil change. You don't have to do any of that with it. You've owned a Tesla, I presume. I know there's no oil in the engine, but right. The maintenance stuff is a whole lot lower. And so I think these dealerships are making money on the margin and making money on, the service aspect of this that goes away with these electric cars. I think for consumers, once it starts heading in this direction and the charging networks get really, really filled out, so you don't have to have that range anxiety. Tesla is wildly popular. They're all over the roads, and you're starting to see more and more electric cars on the road. The Prius has been out, electric only Prius has been out for like a decade now. So I'm not pretending like I'm new to the party. I just got to experience it firsthand this weekend, and it's like, oh, I see where this is going. And a lot more stuff becomes a lot clearer, not excluding, or maybe not, let's not use a double negative, including this fight going on with the major car companies and the United Auto Workers and those unions. Yeah, there's a reason why Tesla trades at whatever multiple of earnings they trade at, and Ford and GM trade at a multiple that they trade at.
I think they trade at a multiple of like 3, 4, or 5, somewhere in that area.
Yeah, somewhere around there.
Which is the market saying. I've heard someone say recently that the market is predicting that they will not be there, and that's why when you get to that low of a multiple,
yep,
people are saying that eventually you're not going to be relevant.
Well, that the Ray Holtz guys had a podcast where it was basically titled, the only car companies that are going to survive are Toyota and Tesla. Notwithstanding, I'm not rendering an opinion on labor unions, but Tesla and Toyota aren't unionized.
Right.
Toyota just hasn't innovated with the lead that they had with the Prius and electric. Like what? I mean, they didn't.
Well, they went high. They wanted to do hydrogen, so I think they probably spent a little bit too much time going down that road, and now
think about how many Priuses you saw on the road, Ryan, 7-8 years ago. They were everywhere.
Yes.
And now they went from Toyota's best-selling car to like their 8th best-selling car. I mean, whatever. I'm just saying we're going in that direction, and your car plugging into your garage is absolutely going to be all over. But this is not a hot take because it's been around for a long time.
It might have been if this was 10 years ago.
Yeah, it might have been if it was 10 years ago. But it was an interesting experiment to run on myself.
I'm glad you were able to see different variables to help make your decision.
Yeah. Oh, I mean, if anything, it's like I've got the burden of choice because there are too many good options. But hey, that's I think that tells you kind of what's in store as more and more of these whether they're startups like Lucid you were talking about, or Rivian or some of these others, or the traditional car companies coming through. I mean, I know a few people that have a Ford Lightning, all love it to a person.
Yep, I've heard the same.
So it's just like you can't fight like the fact that it works well from a technology perspective. Software updates coming regularly. The car that you have now is better than the one you bought 6 months ago. I know that's a novel concept for automobiles, but maybe not for other technology stuff. So it's gonna be cool to see. I'm just gonna have to spend some time and make a decision for myself. So that's what's on my mind. All right. Well, we'll leave it there. If you have made it this far, please subscribe. If you're 40 minutes in on this podcast and you haven't subscribed, what are you even doing here? If you love the sound of our voices this much, you might as well just lock it in, right? So we'll put links to be able to subscribe in the show notes here, whether it's we'll put the link in the show notes for the podcast to our YouTube, and in YouTube to the podcast, and vice versa. I'm Ryan, just for you, I'm going to go find out if we are on some version of Amazon podcasts.
Oh, okay. Well, I could look up the same. I know they have podcasts because they do recommend them to me on like a certain channel.
Sure.
But I'm always thinking, it's probably a very limited amount on Amazon. And that's just me making an assumption.
Well, they're all RSS feeds anyway, but because you listen to Apple Music, I'm putting Amazon Music. I'm going to put an Amazon podcast, casual Friday financial insights podcast link in the show notes just for you. So cool. All right. We'll leave it there. We'll reconnect again in a couple weeks. Until then, let's all keep our fingers crossed for a Fed rate cut.
Sounds good.
All right, Ryan.